When we think about dramatic moments in modern financial history, few episodes stand out like the events of 1992, when billionaire investor George Soros famously placed a massive bet against the British pound sterling. His wager became so consequential that it earned him the moniker, the man who broke the Bank of England. Today, we'll explore what led to this high-stakes showdown, how Soros managed to capitalize on the structural weaknesses of the UK's monetary policy, and what the lasting implications were for Britain, Europe, and global finance. By the end, you'll see just how an individual investor, though backed by enormous resources, could force a powerful central bank to concede defeat and fundamentally alter its approach to the economy. To understand why Soros targeted the British pound, we need to step back to the late 1980s and early 1990s, when the United Kingdom was grappling with its place in Europe's economic landscape. At the time, a significant step towards deeper European integration was the exchange rate mechanism, ERM, established in 1979 as part of the European monetary system. The ERM aimed to reduce currency fluctuations and foster stability among member states by linking their exchange rates to the European Currency Unit, ECU, a precursor to the euro, within a defined band. The UK initially stayed out of the ERM for a decade. However, in October 1990, Prime Minister Margaret Thatcher's government finally decided to join, convinced that aligning with this shared system would help contain inflation and bring discipline to British monetary policy. Under the ERM, each participant committed to maintaining its currency's value within a narrow fluctuation margin relative to the ECU. For the pound, that meant it had to stay roughly between 2.78 dm, Deutschmarks, and 3.13 dm. Its central rate was set around 2.95 dm, to the German currency, long considered the anchor of the system. The UK entered at a relatively high exchange rate, partly due to the political desire to demonstrate strength and partly because inflationary pressures were still a concern. Critics immediately questioned whether the pound was overvalued and if British industry would be disadvantaged by having to compete internationally with a currency pegged too high. Nonetheless, the government, especially Chancellor of the Exchequer John Major, and later Norman Lamont, who inherited the role, felt that anchoring the pound to the strong Deutschmark was a crucial anti-inflation measure. One major external factor that would later amplify the pound's vulnerability was Germany's reunification in 1990. When East and West Germany reunified, the costs of integrating two very different economies soared. The German government financed these costs partly by ramping up public spending. As spending accelerated, so did inflationary pressures in Germany, leading the Bundesbank, Germany's central bank, to raise interest rates to control rising inflation expectations. Because the Deutschmark was effectively the linchpin of the ERM, other member currencies pegged to it were now tethered to a rapidly rising German interest rate environment. For countries like the UK, which was already in the midst of an economic slowdown, the enforced high interest rates, to keep pace with the Deutschmark, exacerbated domestic problems. Higher rates meant more costly borrowing, which could dampen consumer spending, slow industrial output, and hurt real estate market. Meanwhile, the pound looked increasingly overvalued at its ERM entry level. As the British economy weakened, speculation grew that the UK would be forced to devalue or exit the ERM altogether, rather than maintain the high exchange rate against the Deutschmark. George Soros had already earned a reputation as a savvy and aggressive currency speculator. His quantum fund specialized in identifying mispriced assets and making large bets on macroeconomic trends. From Soros's perspective, the logic was straightforward. If the market believed the pound's ERM peg was unsustainable, there was an opportunity to sell pounds short, anticipating that the currency would eventually fall in value. The profit potential was massive, especially if the Bank of England, BOE, lost the battle to defend the currency. In the months leading up to September 1992, Soros and his team monitored the growing tension between the pound's official value within the ERM and the economic realities of Britain. By selling pounds short, he effectively borrowed pounds to convert them into other currencies, particularly dollars or Deutschmarks, with a plan to buy them back at a lower rate once the pound fell. This kind of short position, if taken in huge volumes, could also intensify downward pressure on the currency, especially if other speculators followed suit. Soros wasn't alone. A number of hedge funds and individual traders had also caught on to the pound's perceived vulnerability. But Soros's role became particularly prominent, partly due to the scale of his bets and partly due to his public profile once the dust settled. Quantum Fund is rumored to have made billions of dollars in profit from the pound's eventual collapse, though exact figures are often debated. Throughout the summer of 1992, the British press began covering the likelihood that the pound could not stay afloat at its ERM level. UK inflation rates, though declining, were still higher than Germany's, and the British economy continued to struggle with recessionary pressure. The BO, under pressure from the government, committed significant financial resources to currency interventions, using foreign exchange reserves to buy pounds in open market. The hope was that by creating artificial demand for the pound, the government could keep the currency from falling below the lower limit of its permitted ERM band. However, such interventions have their limit. Britain's foreign exchange reserves, while substantial, were finite, and sustained currency purchases became a losing proposition if speculators kept selling. At the same time, the government tried to keep interest rates elevated to match the Germans. High interest rates theoretically attract foreign capital, improving currency strength, but they also inflict economic pain on domestic borrowers, homeowners, and businesses, particularly in a recession. A critical question arose. Would the UK government be willing to force a deeper recession on the British public just to maintain the currency peg? Tensions peaked in mid-September. As rumors of a forced devaluation grew louder, speculators started dumping pounds en masse. The government's repeated interventions failed to stem the tide. On Wednesday, September 16th, the day that would be dubbed Black Wednesday, the Bank of England attempted a last-ditch effort. Initially, it hiked interest rates from 10% to 12%, hoping the move would restore confidence in the currency. When the market remained unconvinced, the government made a dramatic announcement that rates would go up again, to 15%. This escalation was meant as a signal of absolute resolve to do whatever it took to defend the pound's ERM parity. But even 15% was not enough to break the sentiment that the pound's official value was out of step with economic fundamentals. As the day wore on, it became clear that continuing to defend the pound at all costs would risk depleting the UK's foreign exchange reserves and inflict significant damage on an already fragile economy. By the evening of September 16th, Chancellor Norman Lamont appeared before television cameras to announce that Britain was suspending its membership in the ERM. In the same announcement, he withdrew the 15% interest rate plan, leaving rates at 12%, though within days they would fall back to 10% and then lower. For Soros and others who had shorted the pound, the moment was a triumphant validation of their analysis. The currency plummeted in the aftermath, dropping well below the former ERM floor. When speculators such as Soros eventually closed out their short position, buying back pounds at a much cheaper rate, they realized spectacular gain. Although exact figures are difficult to pin down, Soros reportedly made around $1 billion in profit, catapulting him into global headline. The immediate consequence of Black Wednesday was a political and economic shock for the UK. Prime Minister John Major's government lost credibility, having staked its economic strategy on staying within the ERM. Chancellor Norman Lamont's reputation suffered severely. The UK's ejection from the ERM also cast doubt on Britain's commitment to deeper European integration. Eurosceptic voices within the Conservative Party found new fuel for their arguments that Britain should distance itself from certain European structures. Economically, however, an ironic twist took place. Freed from the ERM constraints, the pound floated on the open market, finding a much lower, more competitive exchange rate. UK exports became cheaper, helping manufacturing sectors and potentially boosting employment. The government could now lower interest rates, alleviating pressure on homeowners and businesses. Over the next few years, the UK economy embarked on a period of recovery, with stable growth and relatively low inflation. Many economists later dubbed this new era a kind of unintended blessing, suggesting that the forced exit might have been beneficial in the long run. Nevertheless, at the time, the political fallout was stark. The Conservative government, which had championed the ERM entry under Margaret Thatcher's successor John Major, was humiliated. Trust in its economic stewardship waned, sowing the seeds for a future political shift. Indeed, in 1997, Tony Blair's Labour Party achieved a landslide victory, partly by capitalizing on the Conservatives' tarnished record. In retrospect, many analysts agree that Soros's bet was successful not because of some arcane knowledge, but because he followed the economic data and realized the UK's position was unsustainable. The interest rate environment needed to maintain the pound's parity with the Deutschmark was simply too high for a struggling British economy. Sooner or later, Britain would have had to devalue or face a severe economic downturn, piling public anger on its leadership. That made the pound an ideal target for short selling. Soros's theory of reflexivity, which posits that markets do not merely reflect reality but can also shape it, played a crucial role in his rationale. As more traders observed the fundamental mismatch between Britain's economic conditions and its currency peg, their collective speculation could hasten the collapse. The large wave of selling then became a self-fulfilling prophecy. By the time Black Wednesday rolled around, defending the pound was, in many respects, a lost cause. The shockwaves from Britain's exit reverberated across Europe. Other currencies, such as the Italian lira, also came under speculative attack and were forced out of the ERM. The event highlighted structural weaknesses in the ERM itself, demonstrating that if member states maintained very different economic cycles or suffered asymmetric shocks, like recession in Britain versus inflation concerns in Germany, rigid exchange rate mechanisms could become untenable. Eventually, these realizations contributed to the design of the euro, which launched in 1999, and physical notes and coins in 2002. Under the euro, participating countries do not simply peg their currencies to each other, they share a single currency governed by the European Central Bank. However, as subsequent crises, like the Eurozone crisis beginning in 2009, revealed, removing currency flexibility can introduce a whole new set of challenges when members' economies diverge. Beyond Europe, Soros's triumph at the expense of the Bank of England added to his legendary status in global finance. It also underscored that central banks, no matter how well-funded or historically influential, can fail if market sentiment decisively turns against a currency peg. In an era of fast-moving capital flows, even robust institutions can crumble if the fundamentals don't support their policy stance. Market versus state. One primary lesson is that government attempts to impose an exchange rate above or below its market equilibrium can be extremely costly, if not impossible, to sustain over time. The Bank of England spent billions defending the pound, only to capitulate. Governments around the world took note that, in the face of concerted speculative pressure and misaligned fundamentals, the market often wins. The power of speculative capital. Soros's trade highlighted just how potent global capital flows can be. While Soros himself was pivotal, he was not the sole actor. Other traders and hedge funds also participated. This collective firepower dwarfed the reserves of many central banks. In the modern era, with highly liquid and interconnected financial markets, large-scale currency interventions are inherently risky endeavors unless the fundamentals strongly support them. Interest rates have real-world impacts. For the UK, maintaining high interest rates to defend the pound had tangible consequences for everyday citizens. Skyrocketing mortgage costs, dampened consumer spending, and threatened jobs. Black Wednesday revealed that a strong currency at the expense of domestic economic health could be politically toxic. Short-term pain, long-term gain. Interestingly, after the pound was set free from the ERM, the UK economy rebounded and entered a period of relative prosperity. Lower interest rates made it easier for businesses to borrow and invest, while exports became more competitive due to the weaker currency. The initial humiliation eventually gave way to an economic upturn that helped restore some measure of confidence. European integration challenges. Britain's ERM exit foreshadowed deeper tensions about the country's relationship with the European Union. While the immediate crisis was monetary, it laid bare the broader debate about sovereignty and control over economic policy, a debate that would culminate decades later in Brexit. Even though the two events are different in nature and historical context, the seeds of skepticism about European economic structures were clearly visible as early as 1992. Speculation isn't merely gambling. While speculator often carries negative connotation, Soros's bet was grounded in economic logic. He recognized a mismatch between policy and fundamentals, an insight that the market eventually validated. This underscores that speculation can serve as a market correction mechanism, exposing flawed policies that might otherwise linger longer and cause deeper harm. George Soros's bet against the pound remains one of the most iconic examples of how financial markets and government policy can collide with explosive results. For the UK, Black Wednesday was initially seen as a national embarrassment, but later reappraised as a moment that helped reset economic conditions for the better. For Soros, the episode cemented his reputation as an aggressive yet insightful macro trader, someone who could read the tectonic shifts in currency markets and time his moves for maximum impact. Politically, the event eroded the Conservative Party's image of economic competence. While the government tried to move on from the ERM debacle, the damage was done. The resentment felt by many Britons, who faced higher mortgages and job losses during the lead-up to Black Wednesday, manifested in a deep distrust of further European integration and of the government's economic strategy. By 1997, the Labour Party capitalized on this disenchantment to sweep into power in a landslide victory under Tony Blair. For the global financial community, the Soros trade against the pound validated the premise that currency markets were increasingly shaped by capital flows so large that even venerable institutions like the Bank of England might buckle. The world learned that in times of economic misalignment, a single high-profile speculator, backed by a strong thesis and ample leverage, could force dramatic policy shifts. This was not the last time Soros would capitalize on market imbalances. He would also famously turn his sights on other regions in the years to come, though none of those episodes rivaled the symbolism of breaking the pound's peg. The 1992 showdown between George Soros and the Bank of England stands as a defining moment in currency market history. Behind the headlines of one man making $1 billion in a single trade lies a deeper narrative about the struggle between economic fundamentals and political will. The UK's membership in the ERM, overshadowed by the powerful German Bundesbank's interest rate policy, became increasingly untenable as Britain's economy faltered. In the end, defending the pound at an artificially high level proved too great a burden, and the government was forced to concede, a triumph for market forces and a stark lesson in the limitations of currency pegs. For Soros, this episode remains both an impressive display of market foresight and a continual source of controversy. Critics decried what they saw as opportunistic destabilization, while others applauded him for shedding light on the untenable positions taken by policymakers. Regardless of where one stands, the outcome of Black Wednesday echoes across history as a testament to how a well-timed and well-financed bet can rewrite a nation's economic course. It also reminds us that, despite the formidable power of governments and central banks, there is a point at which the market's collective judgment can overwhelm even the strongest of defenses. And on that fateful day in September 1992, George Soros showed just how decisive that judgment could be.